Okay, mistake. Okay, that's fine. I think we are live now on YouTube. Right, so coming. Cost of capital question refused to open. Okay, wahala.
Can we snap it and send it to you?
We no. All right. All right, let me see. I don't know what is happening here. So, um, okay. What I'm trying to set up, cost of capital. Okay, what I'm trying to set up my system. Do I have anyone that have question? Right. Ibrahim. So that it is what it is, right? Namesake. Right. It is what it is. Is your own Ibrahim Dende or Ibrahim what? I'm trying to set up.
My own is Makanaki Babalola.
Hey, okay, Makanaki. Okay. Oh, naive Makanaki. I see. Okay. That's fine. That's fine. Wow. I don't know what is happening to my system. Wow. Please just give me some minutes. Let me try to set up the system. Wait, what is happening now? Leslie, just the replay. What is happening? Oh my god. Okay, I have to restart my system. Please, please kindly mute your mic because we are live on YouTube. Right. Okay. Let me just turn off the microphone. Okay, please. I will be back shortly. I need to restart my system, please. Thank you. Okay, I'm back. Please confirm. Can you see my screen? Please confirm. Can you see my screen?
Yes, sir.
Yes,
Who
sir.
are these people sending? Who are these people sending messages to this platform now? Okay, okay, thank you. Some people are in class. Why some are sending messages to the platform? I don't know. Now, wow. Monica, are you still with us?
Yes, sir. Yes, sir.
Okay, that's fine. You're welcome.
Mhm.
Okay, in our last class, right? So in our last class, we were able to solve a question under the cost of capital, right? And which question should we look at? Okay, let's solve this question together. Question 2, right? Question 2. So let me have something here. Suggested solution. Okay. Now, what is our principle here, class? Who can remind me, what are the steps? What are the steps in calculating weighted average cost of capital? What are the steps? Can someone remind us?
Identify the items.
Okay, let's say identify the sources of finance. Do you get? What are the steps? We say identify the sources of finance. So if you identify the sources of finance, what else will you have?
The market value and capital.
No, we start with cost of capital before the market value. Right? Who will help Monica? Try.
First, you identify all sources of finance.
Okay, that is one.
Step, Stage 2, you now calculate the cost of capital for equity and debt.
Okay. 3.
Stage 3 is to calculate the total. Hello, sir.
Yeah, I'm with you, Franca.
Stage 3, we now calculate the total market value of step 2.
Okay. Then we'll determine the WACC, right?
The WACC, in determining the WACC, we have item, market value, cost of capital, and hash total.
Okay, that's fine. That is one method. There is also other way of calculating WACC. We'll get there when we get to other parts of cost of capital. Thank you so much, Franca, for that. You can mute your mic. Okay, now you should not forget that our principle here is first, you read the requirement. Now, calculate weighted average cost of capital, right? Calculate weighted average cost of capital. Now, if you want to determine weighted average cost of capital, you need to identify the company sources of finance. Now, and you can only see that, you can only see the company sources of finance from the financial statement, from the extracts of financial statement given to you. Now, looking at these financial statements now, what are the sources of finance? Who can identify the sources of finance here? What are the sources of finance?
Yes, reserve.
Cost of equity, cost of preference share, and cost of debenture.
Equity and debt.
Okay, no. Okay, that's fine. And someone mentioned reserves.
Yes,
Is
there's
the
reserve.
reserves? Wait, I'm coming. Is the reserves form part of the sources of finance? If you want
No.
to borrow money, will you borrow money from reserves?
No.
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 Reserve is what you have now. So why did you want to go and borrow money from what you have? Class, what is reserve? Reserve is what you have. Your
I was
profits.
viewing it from the point. Okay, sorry.
That's fine. That's fine. From the profits, you remove your dividend. You have retained earning. From this retained earning, the company will now say, oh, out of these 15 naira, we need to reserve 25 naira for a specific purpose. Right? So, therefore, reserve is not part of your sources of finance. Your sources of finance here are the ordinary shares, the preference shares, and debentures. Class, your sources of finance here are ordinary shares, which is your equity. Then you will now be talking about, are you using the dividend valuation method or the capital asset pricing model to determine the cost of equity? Preference shares, from the question we check, sometimes they may tell you that preference shares is redeemable. Anything that is redeemable, any debt that is redeemable, you use internal rate of return. But we've not checked. I'm just exposing you to some things that we may see, right? Debenture, which is loan notes or debenture, is a debt. So we have the three sources of finance. Now we'll go to the body of the question. So please, who will read? Anna.
Present.
Okay.
Good evening, class.
Yeah, good evening.
KK PLC is a manufacturer located in Ogun. The company is trying to decide on the cost of capital to use for the evaluation of the prospective investment project.
Hold on.
Sorry.
Hold. Yes, just hold. Yes, thank you. Just hold. Thank you. It's fine. It's fine. So, can you see? KK PLC is a manufacturer located in Ogun. The company is trying to decide which of the cost of capital. When they mention cost of capital, you should know that it is equity and debt. Cost of capital is equity and debt. To use for the evaluation, is that now? To use for the evaluation, please mute your mic, Maureen, right?
Sorry, sir. Sorry.
Now, to use for the evaluation of the prospective investment project. Class, we should not equally forget what takes us to cost of capital. Is the function of a financial manager. Sources of finance, which is financing decision. Now, you've identified a project. You need to discount that project, right? I'm still checking. Maybe at your level, maybe you have to do something, but you have to use something to discount the project, which is cost of capital. So they are now considering that, okay, how do we evaluate the prospective investment project? You can go ahead.
Okay, sir. The company has an issued share capital of 500,000 ordinary share of 1 naira each, currently quoted at 1 naira 17 kobo per share.
Hold on. Thank you. Now, class, you can see that this is one of the sources of finance, ordinary shares. Now, you can see that from the financials given to us, please pay attention. No, from the financial given to us, ordinary shares is the sources of finance, right? We don't know which of the methods we are to use to determine the cost of equity. Is it that dividend valuation or the capital asset pricing model, right? But I have mentioned several times that from the question, you will know that this is the method you have to what? You have to use. Now, class, the company has an issue share capital, right, of 500. Now, if you look at the capital structure, the financial statement, if you look at it, this is those 500,000 naira. If you divide 500,000 naira, 500,000 divided by 1 naira, we give you what? 500 shares. Is that not so? We give you 500 shares. And that is why you have 500 share, issue share capital of 500. If you multiply 500 shares times 1 shares, the nominal value of this share is 1 naira. Is that not so? It's 1 naira. If you multiply 1 naira times 500,000, you have 500,000 naira. Now, each currently quoted at 1.117 per cum div. Now, this cum div means what? Class, this cum div means what?
Dividend as
Thank you. The dividend is yet to be paid. It means that the dividend. So it means that we have to calculate the market price or market value as div, because they only give us the current quoted price, which is the market price, exclude dividend. That, oh, we've not paid cum div. This is cum div. Class, this is what? This is cum div. You can see that from the financial statement, from the capital structure, from the financial statement. When I say capital structure, means the financial, from the financial statement given to you, you see that ordinary shares comes first. Is that not so? Now, from the story given to you, you can see that you see ordinary shares. So the sources of finance will be arranged accordingly, according to what you are given in the what? In the financial statement. Now, this is part of ordinary shares. Now, in your mind now, you will now ask yourself, okay, this is cum div. Which method are we going to use to am I going to use to calculate cost of equity? Now, okay, you look at it. Is it the capital asset pricing model? Is it the dividend valuation? Right? You can see that no information yet, but we need to move. But we don't know the method to use, but we need to move. Let's read further. Go ahead, please.
Okay, thank you, sir. It has also issued 200,000 naira of 10% debenture, which are redeemable at par in 2 years. In 2 years' time, with the current market value of 105.3 kobo.
Hold on.
And
just so you can see that after the ordinary shares from your financial statement, oh, they didn't even arrange it, they scattered it. Okay. Interesting. Now, where is it? Okay. Now, they move to debenture. It has also issued 200,000 debenture. Then this 10%, don't forget, this is the interest rate on that debt. Can you see it? And they issue 200. If you look at the financial statement, you will see that you see 200. Is that not so? 200. Class, you see what? 200. And debenture which are redeemable at par. Class, debenture which are redeemable at par. I've mentioned this several times. I said any debt that is redeemable, you use what? Any debt that you use what?
You said
internal rate of return. Any debt that is redeemable. Even if they say bank loan is redeemable, use internal rate of return to determine the cost of the bank loan, because it is what? It is redeemable. Now, they now say 10% debenture which are redeemable at par. Par means what?
100%.
100 naira per unit.
100 naira, which means that the redemption, the principal of that debenture will be 100 naira. We can see they just tell you that which are redeemable at par, which means that at the end, though, when you pay interest of 10%, the debenture have a redeemable period of 2 years, which is the redemption principal. At par, par means 100. It means that the redemption will be 100. You can see they use the language at par. Not that sometimes they may tell you that which are redeemable at 100 naira nominal value. You already know that, oh, the redemption will be 100 naira, just like the way we did in our previous class. And it is for what? 2 years. With current market value of what? 105.3. Class, did they mention that the interest has been paid?
No, sir.
No, this is cum what? Market value cum interest. Because the interest, if the interest has been paid, it would have been stated that, oh, they have a market value as interest of this amount, which is 105 naira 0.3 kobo per, maybe it is bond, per bond or per loan note. And move to the preference shares, another the next one, which is debt, and 100,000 of 6% preference shares, currently quoted at 40 kobo per share. Can you see? 40 kobo per share. They didn't tell us that this is this 6%. Class, what is the 6% on the preference shares? Coming to that. Currently quoted at 40 kobo per share. They just tell us that this is the, if they see something is currently quoted, that is the market price currently. You should know that that market price, it excludes dividend, because they say currently quoted. If you go to the NGS now, you check JITCO, you will see the current price of JITCO. If you go to the NGS today, you check, or you go to Unilever, you go to London Stock Exchange today, you check, you see the likes of Apple, Netflix, and Co. You see their current quoted price, which exclude what? Dividend. Now, the preference dividend and the ordinary dividend, including the debenture interest, are due to be paid, are due. What does that mean, class? They say something is due to be paid. It is due.
It is yet to be paid.
Thank you. Thank you. Both they've mentioned that, you can see from our analysis from the beginning, we are picking that this dividend is yet to be paid, or this interest to be, but the question now still go further and say, oh, the preference dividend and the ordinary dividend, including the debenture interest, they are yet to be paid, are due to be paid soon, class. Now, from this paragraph, you can see that they mention ordinary shares as sources of finance, followed by the debt, debenture, and preference share. You can see that they are giving you notes to all those sources of what? All those sources of finance. But from the first place that we want to pick, we want to start from ordinary shares. They give us the current quoted price as cum div, which means that the dividend is yet to be paid. But we don't even know which method are we going to use to determine the cost of equity. Is it the capital asset pricing model or the dividend valuation? Is it dividend, even if it is dividend valuation, is it dividend valuation with growth or without what? Without growth? We don't know. Now, let's quickly read the last paragraph. The ordinary share dividend will be 60,000. Class, the ordinary share dividend will be 60,000 naira this year. And the directors have published their view that earnings and dividend will increase in the what? Indefinite future. Class. The ordinary shares dividend. This is the dividend. This is the dividend. Right? This is the dividend in value, not per share. They just give us the dividend in value this year. And the directors have published their view that earnings and dividend will increase, which means that dividend will not be constant, will increase into the what? Indefinite what? Future. What does that mean, class?
That is
With growth, so dividend growth.
Thank you. Meaning that there is a growth in dividend. So therefore, when you want to calculate your cost of equity under the ordinary shares, you use the dividend valuation with growth, right? Because of the statement. Now, the company current earnings. The company current earnings are 500,000. This is the earnings. Earnings means what? Class, earnings means what? Financial reporting, no. Earnings, current earnings means what? Current earnings means what?
Is the current year profit.
Thank you.
Profit for the year.
Thank you.
Profit for the year.
Current year profit. That is the earnings, right? Their current year profit. Okay. And why the capital employed is 5 million. The fixed asset and working capital of the company are financed as follows. Can you see? They've given us the earnings. So, meaning that, excuse me, we are to determine the cost of equity using the dividend valuation with growth. However, when we want to determine the growth rate, which of these methods are we using? Are we using the Gordon's growth rate model or the extrapolation? Which one are we using? Is it the extrapolation or Gordon's? Ask.
Gordon.
Gordon's growth rate.
Thank you. The Gordon's growth rate. Why? Because all the ingredients you need to calculate the Gordon's growth model is given to you in the question. Can you see that question will just determine which of these methods you will use to determine the cost of equity. Sometimes you may not be given all this information, probably just CAPM ingredients you'll be given, which is the capital asset pricing model. We'll look at that in the second example, illustration. Right? The question will tell you, is it cum div or S div? Is the interest, have they paid the interest? The question, you will see everything in the question. But it's just for you to say, okay, this is your sources of finance. Start from the equity. From equity, you move to what? You move to debt. Now, suggested solution. What is the name of the company? KK PLC. Please, name of company is very, very important. Please. KK PLC. The sources of finance. Ordinary shares. Ordinary shares. Okay. Ordinary shares. So we have to determine the cost. Cost of equity equals to the current dividend, D1 plus 1 plus growth rates plus what, class?
Plus G.
Plus good.
Plus G divided by
Okay, that's fine. Right. Okay, divided by the market value SDIV. Right, or market price SDIV. All this, it is per share. All this is per share, right? Your dividend per share, or you use, recall that in our previous class, I mentioned it that if you are using remember that I mentioned that if your D1, if you want to use dividend per share, use, if it is the total you want to use, make sure that total, in the sense that the total dividend that was paid in that current year, you should make sure that your market value SDIV should be total as well. Now, if this your dividend year is dividend per share, the current dividend per share, make sure that your market value SDIV should be dividend per share. That is the reason why we got cost of equity to be, I think, about 40 something in our previous lecture, right? Now, let's pick it out one after the other. The current dividend. What is the current dividend? What is the current dividend? From your question, what is the current dividend, class? This is it now.
60,000.
60,000. You can see that the 60,000 is in value. Is that not so? So we can get dividend per share, dividend per one. Is that not so, class? So I can have 60,000, class. This 60,000 divided by what? If I want to have dividend per share, dividend per share is calculated as what?
500.
Divided by
Numbers of share. Thank you. If you divide your value divided by the nominal value, this is nominal value. If you divide it, we give you the numbers of shares. But I want to determine the dividend per share. D1, dividend per share. Right? So this will give 500,000 shares. So what do we have? If you divide this,
0.12.
Bashirat and Anna, you're welcome. Okay. So what do we have? Tolulope, Bashirat, Anna. What do we have here?
0.12.
0.12 kobo per share. Good. Class, we are moving, right? Now, class, the market value SDIV. They're supposed to give us the market value SDIV, but we're told that the market value have a cum div currently quoted as this, meaning that currently quoted at this price. Class, meaning that the dividend is yet to be paid. We need to determine the market value SDIV because the formula says market value SDIV or market price SDIV. So how do we determine, since the dividend is yet to be paid, how do we determine the market value SDIV, class?
market value minus
Outstanding dividend.
Okay, thank you. The market price or market value or market price, or you say current market price any English, right? Current market price minus the outstanding, which is the current dividend that is yet to be paid, outstanding dividend. Right? Someone is unmuted. Manika, can you mute your mic? No. That is it, class. I hope. Okay. Let me move first. Now, what is the current market price? That is cum div. 1 naira 17 kobo, right? Are we there?
Yes, sir.
Yes.
1 naira 17 kobo. So we can have here 1.17. It is per share, right? It is per share. That is why you see it's 1 naira 17 kobo, right? I can add it so that you will know that this is per share minus outstanding dividend. The outstanding dividend, because you can see that because your current market price is per share, definitely your outstanding dividend should be per share so that you can minus per share from per share. Not that you will now bring 60,000. You want to minus 60,000. Abi, you want to minus 60,000 from 1 naira 17 kobo. No. If you are going for per share, go for per. If you are going for the value, go for value. Right? In this case, we are going for per share because that is what we will see. Is that not so? Now, the outstanding dividend that is yet to be paid is 0.12 per share. Class, what is the market value or the market price SDIV?
1.05.
1.05.
1.05 naira per share. Class, we have solved that issue. Now, we are moving to the how to determine our growth rate using the Gordon's, because we have identified that the Gordon's growth model will be applicable, right? Gordon's growth model will be what? Will be applicable based on the what? Based on the question, right? Now, met Gordon's growth model for calculating growth rates, which is our G. Growth rate is equals to R times B, right? R times what? R times B. Don't forget that R means the return. The return on what? The return on investments. Okay. R equals to return on investments, right? And return on investment, based on this question, return on investment will be calculated as, based on this question, as what? Profit after tax or earnings given to us divided by the capital employed. Capital employed. Don't forget that in some cases, you have profit after tax divided by the opening shareholders fund. In this case here, we don't have such scenario because the capital employed is given to you and the earnings is given to you already. Class, am I communicating? We'll look at such scenario, more scenario like that as we move, right? But in this case, the earnings is given to you and the capital employed is given to be what? 5 million. So don't even stress yourself by saying you want to check anything. It is what it is. So what is the earnings? The profit after tax, which is the earnings, class?
500,000.
500,000. What is the capital employed?
5 million.
5 million. Okay, what do we have?
0.1.
0 multiplied by 100, that is 10%, right? Let me multiply it before someone will come to my DM, man.
10%.
Okay, 10%. Now, this is R, right? Then B, which is retention ratio. Retention, from the name retain any. Retention ratio. How do we determine the retention ratio? Retention means retain any. Profit after tax minus your dividend divided by profit after tax. That is what we give you ratio. So profit after tax minus the dividend, right, minus the dividend divided by part equals to the profit after tax is 500 minus what is the dividend?
60,000.
60,000, because all these are in value. 60,000 divided by profit after tax times 100. What do we have?
0.88.
Times 100.
88%.
88%.
88% or 0.88. Okay. So therefore, growth rate is equals to R times B, right? This is or 0.1. Growth rate is R times B, which is this is 0.1 times 0.88. Class, what do we have? What is our growth rate?
That's 0.088.
0.088.
0.088. Okay, that's fine. So we can come back to this formula and start all this, right? So current dividend is 0.112. Growth rate, the growth rate is 0.08. The market value SD per share 1.05 per share, right? The growth rate is 0.088, right? 0.088, right?
Yes, sir.
Yeah.
So what is the cost of equity in percentage? What is the cost of equity? What is the cost of equity?
So it's 21.14%.
Okay. 21.14%, or you say 21%. So please, is this clear? Is this clear? Are we good to go? Okay. Now, if this is established, we move to another sources of finance, right? From the story.
Sorry, sir. Sorry, sir. Please, I'm getting a different figure.
Even me.
0.21.
0.21 times 100. What do we have?
Okay, sorry,
It's
sorry,
correct.
sorry.
It's correct.
It's correct. Oh. It's correct.
That's fine. Now, class, before we move to the next sources of finance, we've identified the sources of finance, which is ordinary shares. We need to determine the total market value. Class, is that not the next step? Total market value of the sources of finance. Total market value. And this total market value is what we know, right? It is what we know already. Now, that is the total market value of the ordinary shares, right? It is calculated as the value of ordinary shares. If you check your statement of financial position, you will see the value of ordinary shares divided by the nominal. If you divide it by the nominal, you will have the numbers of shares times the market value SDIV per share. SDIV. SDIV. If you like, write your I'm not saying should I say it? It is market, here is market value S. I didn't say S.
I don't understand, sir.
You don't understand. I know you will not understand that one. That's fine. You don't understand. Don't worry. Okay. So market value as div per share. You can see the reason why it is total market value. Usually you need to get your numbers of shares. When you get your numbers of shares, you multiply it by see this guy. So you multiply it by the market value as div per share. You can see that it makes sense. It makes sense. You multiply it by the share, market value or market price as div per share. Now, from the statement of financial position or from the capital structure, you have the value of ordinary shares to be 500, right? 500,000. Then divided by the nominal value, which is 1 naira. If you divide it, you have the numbers of shares times what is the market value as div, class? What is the market value as div calculated? 1 naira.
1.05.
Thank you. 1.05 per share, right? So what is the total market value? What is the total market value?
535,000. 525,000.
525.
Okay, 525,000 is the total market value. Can you see that we are following our steps? You've calculated, you have identified the sources of finance. You've calculated the cost of equity or cost of debt for the sources of finance. Now, after that, you determine the total market value. When you determine the total market value, you move to the next sources of finance, right? So from the story, we have the debenture, which are to be redeemed. So we move to debenture. Debenture. Please, I hope I'm communicating, please. Debenture, right? Another sources of finance is debenture, and we're told that debenture is redeemable. And I equally say in our previous lecture that any debt that is redeemable, you use what?
IRR.
Any debt.
Internal rate of return.
Internal rate of return, right? And this debenture is actually what? Redeemable, right? This debenture is actually what? Redeemable. Therefore, we need to use internal rate of return to determine the cost of the redeemable debenture class. So internal rate of return, what are the ingredients I need from here? I need the market value as interest. As interest. I need, what did I need again?
Interest.
Interest rate.
Interest rates. Of course, you pay me interest.
Table.
What do I need again?
Tax relief.
There will be a tax relief on the interest rates. Right. What do I have again?
The redemption value.
Number of years.
Numbers of years. Of course. Then, because the debenture is redeemable, so we can have the redemption. There is no premium. We would have add premium to our redemption, just the way we did, just like the way we did in our previous lecture, right? So we move to the market value as interest. So we move to the paragraph. Don't forget that we were told that at the last paragraph we were told that the interest and dividend are yet to be paid. So meaning that the current market value or the market price of the redeemable debenture, is cum interest, right? It is cum value or a cum interest because the interest it's yet to be what? It's yet to be paid, right? So market value as interest. We need to get the market value as interest, right? So which is calculated as the market value, right? The market value or current market price, right, of the redeemable debt, redeemable debenture, minus your interest rate, the outstanding interest rate. Interest. I will not use interest rate. I will use interest, right? Now, meaning that what is the current market price of the redeemable debenture? Redeemable debenture. Class, what is the current market price of the redeemable debenture?
105.3.
105.3. Thank you. Minus, what is the interest rate attached to the debenture, class? Is what? What is the interest rate?
10%.
10%. So how do we convert this 10% to Naira? Who can still remind us how we converted interest rates to Naira in our previous lecture?
That's 10%.
So what is that 100 Naira that you multiply? Is the 100 Naira?
The
No, what is the Thank you.
value.
The nominal value.
Thank you. The nominal value. Right? The nominal value. So we can have 10 naira. Right? We can have, let me open the brackets. Right? We can have 10 naira. Right? Why? Because you have to get the value. You have to get the naira. Right? If your current market price is 105.3, the interest that you will pay, when you pay the interest, you will now have what we call market value as interest. So therefore, so therefore, what do we have here? What is the difference?
It's 95.3.
95.3, right? 95.3. This will be at year zero. At year zero, right? Thank you. So the interest rate already is 10 naira. And don't forget, it's for 2 years. This will be from year 1 to 2. There will be tax relief. What is the tax rate? Are we given any tax rate in this question? What is the tax rate? 40%, right?
Yes, sir.
Yes, sir.
40%. 40% times the interest. What do we have?
That's 40 naira.
That is what?
40 naira.
40 naira.
Okay, 40 naira. No. Oh, sorry. Times 10. 40 divided by 100 times the interest rate. Is that not so? Tax relief on the interest. What do we have?
4 naira.
4 naira. Right? If I don't want to do it this way, it is still the same thing. If I don't want to go through this route, right? Because you will still deduct this tax relief from the interest of 10. Because it is part of the reason why cost of debt is usually lower, because of the tax. If I didn't want to go through this route, I can still modify it and say, okay, I don't want to go by this. I can use the formula I gave you, interest, open brackets, 1 minus tax rate. You still get the same thing. If you minus 10 minus 4, right? 10 minus 4 is 6. If you still use it this way as well, you still get the same answer. Right? Class, am I communicating, please? Am I communicating?
Perfectly.
Okay,
Yes,
that's
sir.
thank you. So the numbers of years is 2 years. So the redemption, don't forget, is at par. Par means 100. That is why we multiply, right? Par means 100. So this will be at the final year 2. So the positive NPV and negative NPV, internal rate of return. So let me quickly copy what we did in our previous lecture. We just copy the table. Where is it? Okay. Still having challenge with my keyboard, but that's fine. Okay. Okay, I think just okay, we can have S interest here to be 95.3. This will be 95.3, right? The interest from year 1 to 2, this is 2, right? The interest rate will be 10. Then this will be what? 4. Why this will change? Right? Then what is the redemption? There's no premium. What is the redemption? That is the principal, right? 100, because it is at par. Par means 100. So please, someone should give me check annuity figure. Check annuity figure quickly. 1 to 2 years. What do you have? Annuity. Do we have anyone that does not know how to, that did not know how to check annuity? A gift. Gift. Okay, I guess it's a mistake. So please check. What do we have? What do we have? What do we have? Quickly. We don't have time.
0.694.
Redemption is what?
0.961.
961. So what do we have here when you multiply?
Sir, for the interest part, sorry, the DCF.
96.1.
96.1. Where is Anna? Are you still in this class?
Sir, for annuity, 1.
Okay, that's fine.
1.9442.
1.942.
Yes,
okay,
sir.
that's fine. 1.942. So when you multiply this, what do you have?
19.42.
19.42. Next, what do you have here?
7.768.
7.768. In brackets.
In brackets.
It will reduce your debt, the cost of debt, right? So what do we have as MPV, the positive MPV?
That's 12.452.
Positive, right? 12.452.
Yes,
that's fine. Thank you. So we move to the next stage, the negative MPV. I can copy the previous one so that we can edit. You should not forget the logic. The lower the MPV, the lower the DCF, the higher the MPV. That is the logic. You don't need to start checking this one will give you this one will give you, no. Right? So it is what it is, class. So we can try, we can just use 10% here.
10.
So we can just use 10%, right? Oh, let me just copy this. This should be mixed. It makes sense for me because I don't need to write anything again. The minutes. Who is that now? Who is that now? It seems you want me to remove you one, right? Isiaku. Isiaku. Right, Ibrahim. Your namesake. Oh. We don't used to disturb class. So that's fine. This is 10%. Okay, I know what to do. Let me remove him from this class. Okay, thank you. So, 10%.
The annuity is 1.736.
1.736. Makes sense. 1.736.
Then for the 10% is 82.6.
Away. No.
No. Sorry. 0.826.
0.826. Okay. When you multiply, what do you have?
Okay. Bonito.
82.6.
What do you have?
82.6.
82.6.
Yes, sir.
So what do we have here? If you multiply this, what do you have? If you multiply this, what do you have?
6.944.
6.944.
6.944.
Right. So when you multiply this, is this correct? 19.36.
17.36.
17.36. Okay. So do we have positive or negative? Negative.
Minus 2.284.
Minus 2.284. 2.284.
Hello,
Okay.
sir.
Still.
Hello, sir.
Yeah, I'm with you.
Somebody is raising a question there. That the tax relief is 1 year in arrears. How do we do
No,
that?
leave
How
that
do we
one. Leave. You know that the tax. That is why at the beginning I usually say we need to understand how these things work. Oh. That one is for tax purposes. It doesn't apply for. I give you money. I gave you money to do business for me, and you're telling me that I don't want to know how you want to pay the interest. Just pay me my interest. That one is for normal accounting profits. It doesn't affect what we're doing here. This is cost. This is cost to the firm, right? When the company is calculating the cost to the firm, it is none of the viability. That one is accounting profit, right? This is costs. Does not apply here at all. So ignore. Thank you.
Sorry, please. How do you come about the 40% tax rate, please?
Do you have the question?
I have the question.
Okay. Check. Scroll down. The last paragraph.
that table?
Before the required.
Okay, I've seen it. Thank you.
Basirat, will go fight.
I'm sorry. I didn't see it before. I've seen it. Thank you.
Yeah, that's fine.
Hello, sir.
Yeah, I'm with you. I am in there.
Please quickly, can you give a reminder of how we got how we can solve for annuity? Thank you.
No.
That was the same question I wanted to ask. Like the formula, I'm mixing them up.
No. But were you in class in our last class? Were you in class?
Yes, I was, but it was not stated. They were just giving answers.
No. No, now. Nafisat. This is it. You can see the way we bring them out. No. If you check it very well, we bring everything out one after the other. In the first class, we bring it out so that you know how to determine the annuity. This is the formula for calculating annuity. And this is the second formula is for the DCF. If you use it, you will get what they have here. So you can do that, right? So the DCF, you should not mix it up. That an iron in there. Okay. If it is from year 1 to 5 or from year 1 to anything, you use annuity. Okay. But if it is just for this, only for this year, you use this DCF. So you should not be mixing them up. Okay.
Yeah, thank you.
Yeah. Any other question, please? Okay, Matthew. A quick one, please. We have time is far spent, please. I need to go quickly. Matthew.
Good evening, sir.
Good evening.
Yes, sir. I just want to ask for how we are using this 1 to 2. Is it the same with, instead of saying 1 to 2, is it the same with doing it year by year, or this one is different?
You can do it year by year, but that one, come on, that one will just waste your time. So you want to do, you pay interest. You pay interest in year 1, you pay interest in year 2. So you want to be doing it 1-1. Fine. You can do this one after the other. Anyone that you want to do. Fine. Do you get? So
Yes,
that's
sir.
it. Yeah, thank you.
Thank you, sir.
You're welcome. Bashirat. Okay. Gift. Okay.
Sir, please, I want to ask concerning the question on cost of capital. It's not always stated the kind of model we are to use, right? We are to dictate it ourselves from the question.
Sometimes.
All the time.
Sometimes. We'll see, look at you. If you check the questions, those questions, you see that I think question 4 or question 5, the question state that you should use which one of the model you are talking about? Is it dividend valuation model or capital asset pricing model? Which one?
Like if you have a question on dividend valuation.
Okay, dividend.
Model.
Yeah, no. Sometimes the question will tell you that using this, like this question now, the question says ignore the project, calculate the weighted average using what? Capital asset pricing model.
Capital asset pricing model.
You understand? So sometimes the question will tell you, sometimes you just need to use your check from the question.
And check it.
You understand from the question. So I think like this question too. So some question will stay, some question will not stay. So you'll be the one to know which of the method you use. So if they give you all the ingredients, use it.
Okay. Thank you, sir.
You're welcome. So I think we are good now. So we need to move, please. So internal rate of return. Internal rate of return. All right. Let me quickly copy this formula. Internal rate of return. Right. Internal rate of return, positive and negative. Okay. So this is the formula for calculating internal rate of return. Lower rate, the lower rate is 2%, is 2, right? The lower rate is 2. What is the positive MPV, class? The positive MPV? What is the positive MPV?
12.452.
12.452. Then positive 12.452. So the negative minus times minus. Thank you. Minus times minus is plus.
Right.
So we can have
2.284.
So higher rate
10 minus 2.
Thank you. 10 minus 2. Lower rate is actually 2. Right. So what is the cost of redeemable debts?
8.76%.
Thank you.
Sorry, sir. Sorry, sir.
8.76%, or you can say 9%. So you can suspend your question till finish this question, please. So after the question, after we've finished solving, you can ask your question, please.
I can't see
Thank
your
you.
screen, sir. Your screen is not displayed, sir.
You said, what do you have? Class, is this correct?
Yes, yes.
Yes.
So, okay. Oh,
Sorry, sir. I want to talk about observation on the formula. I think it's lower rate plus NPV all over NPV of lower rate minus NPV of higher rate.
it's still the same thing.
It's not the same
Right.
thing, sir. The formula there is minus. So
Okay, because you
when
see
we now
minus.
bring the
Joy.
yes, I understand, but we have to just put the normal calculation.
No,
Why
there
I'm
is no
saying this
need.
is that
There is no need, Joy. Anybody that wants to learn that one should go and check the formula for calculating internal rate of return. I don't need to put minus so that you know that it is plus. Minus times minus is plus. I don't need to do that. Anybody that wants to check, you can just check on your own and check why do we have plus. Minus times minus is plus. The higher rate minus lower rate, we give you what we have here. So anyhow that you want to do it from the formula, anyhow, you still have the same figure. You still have the same what? The cost of debt, right? Joy, do you get?
yes, I get.
Okay, so let's quickly move. We need to calculate the total market value. So we now say value of, is redeemable debenture, right? Value of debenture from our statement of financial position divided by the nominal value, just like the way we did ordinary shares, right? Times market value S interest. So what is the value of debenture in our financial statement? Quickly, class. What is the value of ordinary value of debenture? What is the value of debenture?
200,000 naira.
200,000.
200,000. 200,000. Oh, where is it itself? Okay. I think I have to move this down. So that's okay. It's 200,000 divided by what is the nominal value of the debenture? What is the nominal value? What is the nominal value, class?
100.
Wow, others are not saying anything now. What happened? Are we tired?
I can't see your screen. I can't see your screen.
Okay, it's your network actually. You can log in, you can log out, Abi, and log
I've
in.
done that now. Logging back is the same thing.
Yeah, it's your network. It's from your end, please. Thank you. Class, why do we have to use 100 naira? It is at par. That is the nominal value. Class, it is at par. That is the nominal value times. If you divide it, we give you the numbers of debenture. So times the market value S interest. What is our market value S interest? 995.3. So what do we have here?
190,600.
190, 600. Class, is this clear? Are we good to go?
Yes, sir.
Yes.
Okay, that's fine. What is the next sources of finance? What is the next sources of finance? Preference share, right?
Shares.
Preference shares. Is it stated in the question that the preference share is redeemable? I guess no. Please, any cost, any debt that is redeemable, please, you use internal rate of return. Okay? Now, Franca, are you still in this class? Oh. Okay. Okay. What is the formula for calculating the cost of preference shares? Equals to, what is the formula, class?
Dividend over market value XP.
Okay. Current preference share dividend divided by the market value SDIV of the preference shares. Now, we need to go back to the story where they give us all those long information. Let's see if we have the current preference share dividend for preference share. Let's check. And 100,000 of 6%. This 100,000 is the value of preference shares. Of 6%, preference shares currently quoted at 40K per share. You can see that they only give us the current market price, which means this is cum div. The dividend of the preference share is yet to be paid. But the question is, what is the dividend of preference shares? Now, this question, I think, is actually adopted from ACCA because it's kind of tricky. From the preference shares, they're supposed to give you the preference shares dividend supposed to they're supposed to state the preference share dividend to be this, but we're not given the preference share dividend. But in a situation whereby the preference share dividend is not stated here, class, the 6% given to you in this question, class, the 6% here we assume to be the what? Will be the preference. Is not assume. Will be the what? The preference shares. Meaning that you need to convert this 6%. This 6% means what the shareholders will take. What the preference shareholders will take is not interest. Is like their dividend, right? Because you have to pay them before the ordinary shareholder. What you will pay the preference shareholder is the 6%. Class, in some question, they will give you that, oh, the preference share current dividend is this. They will give you the the amount, the figure. But in a situation whereby it is not given, just go to the statement of financial position. You will see it in the statement of financial position, 6%. Just go straight to your financial position. If it is not given in those story, right? You can see that it is not even given. The preference share dividend, the current dividend for the preference share was not stated. Not that it is not given, was not stated in the story. Is that not so? Now, you quickly go to your financial statement. The 6% means that will be the 6, that will be the what? The dividend that the preference shareholder will take. Class, the 6% will be the preference share dividend. If it is not given in the what? In in the story, just check your what? Your financial statement and pick the 6%. The 6% represents the current dividend that will be paid to the preference shareholder. Class. Now, in another case scenario, where if you want to test, if you want to like show yourself, maybe you want to test it again. Now, in the question, you'll be given that the preference share dividend is 6 naira, for instance. If you come to the capital structure, if you come to the financial statement and check the percentage of preference share, you will see that it will still be 6%. Why? Because they've given you 6% in the story, while in your financials you will still have 6. So meaning that when it is not given in that story, you come to the financial statement and pick the percentage that is related to the what? To the preference shares. Meaning that that will be the current dividend of the what? Of the preference shares. And you can see that you see the nominal value to be 100. So we need to convert that 6% to naira. Class, am I communicating? Are we still together?
Yes, sir.
Okay.
So let's quickly convert this first. The current dividend for the preference shares will be equals to 6% divided by 100 times what is the nominal value is 1 naira, right? 1 naira, right? This will give us 6 naira per share, right? And don't forget, the market value that was given to us is cum div. S interest, S div, market price minus outstanding dividend.
Sorry, sir. How did you get 6 naira?
Oh, sorry. What do we have? Thank you.
0.06.
Thank you. 0.06. Thank you. I was thinking the nominal value is, I'm used to 100 naira. Sorry. That's fine. Thank you so much for that. So what is the market price given to us in the question? So what is the market price of the preference share? What is the market price of the preference share?
40 kobo.
So you can convert the 40 kobo to naira, right? You divide it by 100. You have your, since we are using naira here, right? So we can have 0.4, right? That is 0 naira. Please, if you don't know how to convert, let me know so that I will teach you how to convert 40 kobo to naira. 40 divided by 100. What do you have? That is how to convert. 0.006. What do we have? What is the market value? What do we have?
0.34.
0.34. That is the market value as div. So we can now apply to be current KE equals to the current dividend for the preference shares, 0.06 divided by the market value as div, which is 0.34 times 100. Right? What is the cost of equity? What is the cost of equity for preference shares? Cost of preference shares, sorry. Cost of preference shares, sorry, not equity. Cost of preference shares.
17.65%.
17.65%. 65% or 18%. So from our steps, we need to determine the total market value. Total market value equals to value of preference shares in your statement of financial position, please. The value of preference shares divided by the nominal value times the market value as Dave. Class. What is the value of preference shares in our capital, in our statement of financial position? What is the value of preference shares? Quickly, class.
100,000.
100,000.
100,000.
100,000.
100,000. Are we tired? Yeah, I'm not tired.
No,
Though.
no.
I need to finish this question, right? Divided by 1 naira times, if you divide it, we give you the numbers of shares times 0.34. What is the total market value? What is the total market value?
34,000.
24,000?
34,000.
34,000.
34,000.
4,000.
So we are done. These are the three sources of finance that has been stressing us since. Just three sources of finance. Just three sources of finance. Imagine. That's fine. We need to determine the weighted average cost of capital. Weighted average cost of capital. There are two formulas to determine the weighted average cost of capital. Right? So we have the items. Total market value. Cost of capital, which can be equity or debt. Ash total. Ordinary shares. Please, I need figure. What is the total market value for ordinary shares? Wait.
525,000.
525,000.
Ah, someone say 500,000. Okay.
525,000.
Okay. 525,000. What is the cost of equity? What is the cost? How many percent? How many percent?
21.
Okay, I have to go back and check. Let me check. 21%. 21%. That is 0.21. The next one is what? Debenture. Redeemable debenture. What is the market value?
$190,600.
190,600. What is the cost?
9%.
9%. 0.9. Is it 0.9, Obi? 0.09.
0.09.
Thank you. Preference shares. Preference shares.
34,000.
34,000.
18%.
What is the cost? 18%. 0.18. Please on to the total market value. Right? Weighted average cost of capital is equals to, I will teach you the second.
749. Total market value is 749,600.
749,600. So when you multiply your cost of capital times the market value, what do you have here? This is A.
117.
I know some of you have watched the video on how to calculate.
110,250.
Okay, what do we have?
110,250.
250. What do we have here?
17.150. 17.154.
17. I don't understand.
17,154.
17,154.
Okay. So what do we have here?
6,120.
6,120.
6,120. So what do we have here? What do we have here as the total? 524. Right. So weighted average cost of capital equals to, what is the formula, class? What is the formula?
Hash total divided by market value times 100.
Hash total divided by the total market value. You can see that this is what we call, what do we have? What do we have for?
17.1 or 17.8.
17.8%. Class, this is what we call market value weighted average cost of capital. This percentage is called market value weighted average cost of capital. Do you know why? Because, do you know the reason why it is called market value weighted average cost of capital? Because in your calculation of your weighted average cost of capital, you include the current market value of either the equity or debt. So in some question, when you will now be told that calculate the market value weighted average cost of capital, don't be confused, right? Don't get confused with that language. It is still the same market. It is still the same, your weighted average cost of capital. In some question, when you will see calculate after tax weighted average cost of capital, it is still the same thing because you've considered tax. You've done your tax relief on your what? On your debt. So it is still the same thing as your normal weighted average cost of capital. Now, the only difference is when you have book value weighted average cost of capital. In our next class, we'll be looking at the comparison between the book value weighted average cost of capital and the market value weighted average cost of capital, or either you call it market value weighted average cost of capital or after tax weighted average cost of capital, whichever name you want to, the examiner wants to call it, right? It is still the same thing. So we'll now look at the comparison between the book value weighted average cost of capital and the weighted average or the market value weighted average cost of capital. So distinguished professional colleagues, I think I've been able to do justice to this question, right? Adopted from, I think it's from ACCA. Yeah. So thank you so much, everyone. Please, if you have questions, just 5 minutes. So quickly unmute your mic and ask your question before we go, please.
Hello, sir.
I'm with you. Can
you scroll down to the positive and negative NPV?
Okay. This is negative and this is positive.
Thank you.
You're welcome. So Adedayo.
Sir, I just want I want to ask, you said something about the annuity and the discounting factor. If it's not up to 5 years, we should use annuity, but if it's below 5 years, we should use discounting factor. I didn't get that explanation, sir.
Were you in class in our previous class?
I was not in the last class, sir.
So you need to go back and watch this. Because we've talked about it in our previous class as well, right? So if you have that is the reason why I say we need to just understand this thing. You are paying interest, you are owing me. You will pay me interest from year 1 to year 5. How many years is that? Is it not 5 years? Or you will pay me interest from year 1 to 2. Right? You use annuity because you pay interest year 1, year 2, year 3, year 4, year 5. But the last year is the redemption. Are you going to be paying redemption principal from year 1, year 2, year 3, year 4, year 5? No. So you use the normal DCF for the year 5, which is the redemption either convertible or redemption or redeemable, whichever one. And that is the reason why we use DCF for year 5, like your principal. So please, you need to go back and check. Do you get? Do you understand?
Yes, sir. Thank you, sir.
Yeah, you're welcome. Timothy.
Good evening, sir.
Yeah, good evening.
I want to ask a question about the sources of finance that we have, the cost of equity, debenture, and the preference shares. The percentage we got for each source of finance. We are having 21% for the cost of equity, while 9% for the debenture and 18% for preference shares. So what I want to ask is that at this level of the percentage we got, can we say that this is the normal rate for the cost of the sources of finance, or there is any implication about the percentage we have gotten? And also, what should be our advice as a financial manager to the company that, okay, for the part of the source of finance, maybe they should go for debenture, since the debenture is we give them the lowest cost of we give them the lowest cost.
Okay, that's fine.
And
That's
also
fine.
we are having the same percentage for the prevention and the weighted cost of equity, weighted average cost of equity.
Thank you. Thank you. You begin to think like a financial manager or investment analyst. That is a very good question, right? Let me just pick it up from the ordinary shares. You could see that the percentage of cost of equity is higher than debenture and preference shares. That is the reason why they say the cost of borrowing fund, right? For under the equity, you can see the reason why from the beginning of our cost of capital, we said cost of equity is usually higher cost of debt. Can you see it? Now the debt is lower. You have 99%, you have 18%. Is that not so? So we may look at it, but in a situation like this, how do we advise the company? Because this is just the weighted average cost of capital, meaning that the average source of their finance will cost them 17.8%. Right? We cost them 17.8%. What? Some company may look at it that 17.8%, does it make sense? Are they going to meet up with this debt? They look at it and they say, oh, they will not be able to meet up with this debt, so they have to reduce their cost of borrowing, right? Either to say they don't want to use, maybe they may say, oh, because of that 21%, they don't want to use dividend valuation method. They may try capital asset pricing model to check if the cost of equity will be lower using the capital asset pricing model. With that, their weighted average cost of capital may actually reduce as a result of reduction in the cost of equity using the capital asset pricing model. But in this for the purpose of this class or in this question, we're not told to actually do something, but I like the way you reason, right? That makes sense. Well done, Timothy. Makes sense. Well done, Timothy. Yeah, you're welcome. Olabisi, I have limited time away. Please.
Yes, good evening, sir.
Yeah, good evening.
Class.
Good evening.
I have an observation. I noticed that we are currently taking cost of capital, which is under business finance, according to the syllabus. Is there any reason why we cannot take the topic as laid out in ICANN syllabus?
No.
And if not, can we have a topic outline for this class?
We have it already. We have it. I think I sent it to the platform, the syllabus as the ICANN syllabus. One thing, I can't even start the way it's where in the words in the syllabus. I think I started with objective of a financial manager according to what it's stated in there as I can't arrange it in the syllabus, right? So I started from there and I look at it that working capital, leave working capital for now, leave it one side because of one or two reasons. Personal reason is a strategy actually, right? It's a strategy, right? And we need to move from there. You know, this thing is just interwoven. If you don't understand A, you can't understand B. And that is why Next Gen Professional Associate is different from others. You can go and check. They will scatter it to the extent that you don't even know the one, you don't even know how it is being applied, even in real life situation. Imagine someone that did not know, that did not understand cost of capital, and you want to take working capital. How come now? Imagine someone who did not understand cost of capital and you want to take business valuation, taking business valuation. You know, it doesn't work that way, right? What lead us to cost of capital is the function of a financial manager, which is the investment decision, the financing decision, the dividend decision, right? Investment decision will take us to investment appraiser, right? The financing decision will take us to the sources of finance, which is cost of capital, right? Dividend decision will take us to dividend policy, right? Now, you need to understand the financing decision so that you will use that financing decision to make an investment decision, whether you use it to discount the project. When we are done with this part, we move to another part of cost of capital. From there, we will now move to investment appraisal. So there is a way I arrange it in my plan work. Do you get? So it is what it is, right, Olabisi?
Okay, thank you so much for that. I would still appreciate if you can just let us have it as laid down in your own
no, don't worry.
portfolio.
Don't worry. You can't get that one, but you can always get the one I will put out, right?
Okay. That's all right. Also, sir, is there a way we can be having the materials before the class?
No,
so
you
that
can't have it. Sir, do you know? No, wait, now let me cut you. You can't have it before the class. Do you know why? I always do adjustment. You see, every 5 minutes, things come. I have to change some. It is not an AI generated material. It is, I sat down with it and think about what students will understand. You understand? So every minute, I always change it. I always change that. Okay, why? Okay, we should use this formula. This formula will work. You get? Like this cost of capital now, you already have it. You get? You already have it. So you can always go back and check. But like this suggested solution, you can't get it. Just go to the YouTube. You must write. If you are not writing in class, either you write in class or you write after the class. Do you understand?
For this cost of capital, I do not have the current.
You don't do what? Sorry?
I do not have the current question we are taking.
Have you paid for the material?
I paid.
But you don't have this cost of capital. This question. No, please, you can go and check, please. You can check your drive. You check your drive, is there, actually. So thank you. Thank you. Any other question, please?
Mr. Ibrahim, can you take it back to the IR, please? I want to take a shot of it.
Victoria, right? Quickly. Victoria.
Okay, please, after
Please, can you be audible? I can't hear you.
Hello, can you
Yeah, I can hear you now.
hear me now? Can you hear me?
Yes, I can hear you now.
Please, can you, after the IRR, can you take it up to redeemable debentures?
Why? Do you want to ask question or you want me to take it to the redeemable debenture?
I said it, I don't want to ask any question. I said it on the group chat, on the chat rather, that please take it up to redeemable debentures.
This is redeemable debenture. This is it. This is where we started from, right? You can always go back to the YouTube and check all these things. Just check and pause. Then copy whatever you want to do on it. Do you get? So Brian.
Okay, so what I want to say is this is maybe like 10:30. We are not tired though. Let's continue. That's my own.
Continue. Okay, are you not going to work tomorrow?
See this guy. See this guy. They play.
Only you can continue now.
They've attacked you. Even Tolulope. Please, we need to go. Please, thank you so much, everyone. You can reserve your questions till our next class, right? So we need to go. Honestly, our time is fast spent. You're in there. Iberi.
Sorry, sir. Are you with me?
I'm with you, please.
I just need clarity on something. So for every question as such, we have to solve for both the cost of this thing and also the total market value. For instance,
yeah. I can Let me cut you. Go and check the playlist. You will see step-by-step approach to determine weighted average cost of capital. You see that step? That is the only step you need. Okay. You identify the sources of finance, the cost. So these are the steps you just need. Do you understand? So yes. Any day, anytime you are told to calculate after tax weighted average cost of capital or market value weighted average cost of capital, these are the steps, right? You use that step.
Thank you.
Understand?
Thank you very much.
Yeah. This one will be like a compulsory question, no?
Iberi. Yes. I think it takes about 20% of the syllabus, right? 20%. If you check under the business, I think under the business finance, it takes about 20% of the syllabus. Yes, 20%. You understand it, right? Financial management is not new. As far as I'm concerned, it's not new to me. So we'll break it down. We'll do revision. We'll do a lot of things under FM. You get? You don't need to be scared about it. Don't be too much. You just have to work, right? Your effort matters a lot here. Everybody, all of us, we have to work it out together. Your effort. Immediately after this class, you have to go back and watch it again, right? Understand it. Understand the reason why we have to do this. Understand the reason whether you need to go back to cost of capital part 1 again and check how we explain it from the beginning. You can do that, please. Don't forget that sources of finance is a topic is another topic on its own. And most of you have actually checked that we've updated the folder with the sources of finance. You can see that I put some questions there, 2 questions. All those questions are the last thing we need to do, maybe last. But then, please read on that sources of finance. It's very important, please. So, are we good? Ibrahim, you will be the one to take the class, maybe when I'm done with my class. Okay, all right. Thank you so much, everyone.
Sir, let's have it in our policy. Well, before we start and when we finish, let's put everything on God's hand. That's my own.
Okay. All right. Iberi, do you want to ask question? Iberi. Okay, I think maybe it's a mistake. Sure. Okay, thank you so much, everyone. Thank you.
Sir Ibrahim, thank you very much. Yeah.
Thank you so much, sir. God bless you.
Amen. Kilo shele. Hey, okay.
Kudus, can we go and sleep?
All right. Thank you so much, everyone, for joining. And enjoy the rest of your evening. Okay. Thank you.
And you too, sir. Bye,
Yeah,
sir.
thank you. Yeah, thank you. Thank you, everyone. Thank you.